Every time the world falls into crisis, wars, energy shocks, financial instability, something strange happens. Instead of collapsing, the United States often comes out stronger. Coincidence? Or is there a deeper economic system behind it? In the 2020s, the world has entered a new era of geopolitical instability. The Russia Ukraine war, Middle East conflicts, energy shocks affecting global supply chains, oil markets reacting instantly to geopolitical tension. For example, whenever conflict threatens energy routes like the Strait of Hormuz, where roughly 20% of global oil passes, prices surge. But the global impact is uneven. Some economies suffer, others gain strategic advantages, and the United States often finds itself in a surprisingly strong position. In the past, oil shocks devastated Western economies. Think about the 1970s oil crisis. Back then, the world depended almost entirely on OPEC. Today, the situation is very different. Three major changes happened. First, energy diversification. Renewables like solar and wind now supply meaningful energy. Second, efficiency improvements. Technologies like LED lighting and electric vehicles reduce oil dependency. Third, American shale oil. The United States has become one of the largest oil producers in the world, producing over 13 million barrels per day. That dramatically changed global energy dynamics. When global supply is disrupted, America is no longer the biggest victim. Sometimes it becomes the buffer. Why the dollar gets stronger in crisis? During war or global uncertainty, investors run towards safety. Historically, that safety has three assets: gold, US Treasury bonds, the US dollar. This phenomenon is called safe haven flow. When crises hit, capital leaves emerging markets and risky assets and flows into the United States. This strengthens the dollar, even when the crisis is geopolitical. Why? Because the US financial system remains the largest, most liquid, and most trusted in the world. This pattern is not new. Look at World War One. Before the war, the US was a debtor nation, borrowing capital from Europe. After the war, Europe was devastated. America became the largest creditor nation on earth. Then came World War Two. Europe and Japan were destroyed economically, but US territory was untouched. American industry boomed producing weapons, machinery, food supplies. By 1945, the United States controlled nearly half of global industrial output and held the majority of the world's gold reserves. This allowed the US to establish the Bretton Woods system, placing the dollar at the center of global finance. After World War II, the US launched the Marshall Plan, a massive reconstruction program that funded European recovery. On the surface, it looked like humanitarian assistance, but economically, it achieved three strategic goals. 1. Rebuild Europe's economy. 2. Prevent political instability and Soviet influence. 3. Integrate European markets into the US led financial system. It created a system where European economies recovered but remained tightly connected to American finance, trade, and technology. A classic win win structure. War is not always good for the US, but history also shows something important. War can hurt the United States too. The Vietnam War created massive fiscal pressure. Government spending exploded, inflation surged, and in 1971 the US was forced to abandon the gold standard. The Bretton Woods system collapsed. This led to the stagflation crisis of the 1970s, meaning low growth plus high inflation. So the idea that war always benefits America is simply wrong. Sometimes it causes deep economic problems. Today, the US maintains the largest defense budget in the world, nearly $900 billion per year. But here's something many people misunderstand: the defense sector is actually small relative to the entire US economy. The market value of tech companies alone far exceeds the entire defense industry. However, military spending has one huge side effect: technology innovation. Many technologies originally came from defense research. Examples include the internet, GPS navigation, early computing systems. These technologies later became massive civilian industries, meaning defense spending often creates innovation spillovers. Despite popular theories about war profits, the real foundation of American economic strength is something else: its institutional system. Key factors include open capital markets, legal protections for investors, free movement of capital, strong property rights, transparent financial systems. Because of these institutions, global capital continues to trust the US, which allows the government to borrow easily, even with national debt exceeding $34 trillion. However, the system is not unlimited. There are real risks. If debt continues rising too quickly, interest payments could become overwhelming. If the US ever needs to borrow simply to pay old debt, that would signal serious structural problems. For now, global investors still trust the US system, but that trust must be maintained. So, does America profit from global instability? Sometimes, but not because it wants war. The real reason is structural. When the world becomes uncertain, capital, talent, and investment tend to flow toward the most stable system. And for over a century, that system has been the United States. In a world shaped by geopolitics, understanding how money moves during crises is one of the most powerful financial skills you can develop. If you enjoy deep financial analysis like this, subscribe for more insights into global economics and investing. But while this video explains the historical relationship between war and the global economy, something very real is happening right now. In the past few days, tensions between the United States, Israel, and Iran have escalated dramatically, and the first market to react was oil. Global crude prices surged above $90 per barrel, the biggest weekly jump since the COVID era. Analysts now warn that if the conflict continues, oil could reach $120 or even $150 per barrel. Why? Because this conflict threatens one of the most important energy choke points in the world, the Strait of Hormuz. The Strait of Hormuz, problem about 20% of the world's oil supply, passes through this narrow waterway between Iran and the Gulf states. When the conflict escalated, tanker traffic collapsed, shipping insurance skyrocketed. More than 150 oil ships stopped moving through the strait. This effectively disrupted one of the most critical arteries of global energy trade, and the consequences spread immediately across the world. Global market reactions within days. European gas prices surged, stock markets across Europe and Asia fell sharply, airline stocks dropped, inflation expectations jumped. Financial markets began pricing in a scenario where energy shortages could push the world economy into another inflation shock. Energy markets are incredibly interconnected. Even a regional conflict can ripple through shipping, supply chains, food prices, and global interest rates. Why this conflict matters for investors. Historically, three assets react quickly during geopolitical shocks. 1. Oil rises. 2. The US dollar strengthens. 3. Capital moves into safe assets. This pattern is already visible again. Oil surged, markets became volatile, and investors began shifting money into safer financial instruments. The key lesson: geopolitics is no longer just political news, it is financial news. Because in today's world, a conflict in the Middle East can affect inflation in Europe, interest rates in the US, and stock markets in Asia. Understanding these connections is one of the most important skills in global investing.